You're welcome back. Now let's look at these examples of share-based payment transactions. The first one says that entity A enters into a contract to purchase silver for use in its jewelry manufacturing business. Under the contract, entity A will pay the supplier a cash amount equal to the value of 1,000 shares of entity A at the date the silver is delivered. Obviously, this is a cash settled share-based payment transactions because the entity will be paying cash that is equal to the price of its shares. Okay, so that is a cash settled share-based payment. Let's look at another one. It says that entity B is delivering a new product and purchases a patent from entity C. The parties agree a purchase price of 1,000 of entity B's shares. This will be issued to entity C within 60 days of finalizing the legal documentation that transfers the patent from entity C to entity B. Don't get confused. This is an equity settled share-based payment because the payment involves issue to entity C, issue of shares to entity C. Okay? So it is an equity settled share-based payment. Another one says that entity D acquires 90% of entity E's share capital. As part of the acquisition, entity D grants share options to entity E's employee that vest after 2 years if the employee remain in service. Think, should this be a share-based payment? Okay. You know what? It is really a share-based payment. Even though, if you remember my explanation, I said that where an entity receives goods in exchange for shares in a business combination, like we learn in group account, that it is not a share-based payment. However, they told us clearly that entity D grants share option to entities E's employee that vest after 2 years if the employee remain in service. So the equity instruments are granted to employees of the acquiree in exchange for future services. Okay, so it falls within the scope of IFRS 2 and it is an equity settled share-based payment. Another one says that entity X and entity Y have formed an incorporated joint venture known as entity Z. On formation, entity X contributed property, plant and equipment, and entity Y contributed intangible assets that do not constitute a business in exchange for their interest in entity Z. Now, this is really a complex area, but this is what I want you to understand. That the asset contributions by entity X and Y, okay, to entity Z formation, it is an equity settled share-based payment. Do you know why? Because they told us clearly that the assets they contribute do not constitute a business. Okay? They are just contributing the assets so that they can have shares in entity Z. Therefore, it is a share-based payment. This is different from business combination. Okay? Please note that. Now, let's look at another one. It says that a non-quoted entity issued share appreciation right to its employees. And the share appreciation right entitles the employees to a payment equal to any increase in the entity's share price, okay, between the grant date and the vesting date. The arrangement terms and conditions defined the share price used to calculate the payments to employees as follows: 5 times the EBITDA, that is the earnings before interest, tax, depreciation and amortization, divided by the number of shares in issue. Now, the challenge with this is that ordinarily it should be a cash settled share-based payment. Okay. However, because what the entity is issuing, okay, the entity will issue cash or will give cash to the employee. However, the way the cash is calculated is not just based on the share price of the entity, it's based on the EBITDA. Okay, and that cannot really show or reflect the fair value of the entity's share price. Okay, so IFRS 2 will not apply. It's simply like you're just paying your employee, so it will be treated under IAS 19. Okay, and last one is an entity agrees to pay its employees a bonus, and it has a choice of settling in cash or by issuing shares with a value equivalent to the cash payment. The entity has past practices of settling in cash and is considering whether the transaction is in the scope of IFRS 2. Okay. You see, based on what you learned in IAS 32, if you remember, that this is like issuing a variable number of shares, okay, for a fixed amount, right? And if you remember, we said that would be a liability, is a financial liability. So from the perspective of IAS 32, it could be argued that this type of award, okay, or bonus should be in the scope of IAS 19, just like we want to pay our employees and not IFRS 2. But because the entity has a choice that allows it to settle the award or the bonus using equity instruments or cash, then the transaction is a share-based payment with a settlement choice. Okay? So it will fall under IFRS 2 just because of that. Okay? So I hope these have thrown more light on what share-based payment is. See you guys in the next video. Cheers.